Hi, I'm Barry Norris. For our absolute return fund, we hedge our market exposure through shorts to deliver a valuable return profile not dependent on market beta and therefore different from 99% of other funds. Without the ability to short, equity savings products would become all dangerously dependent on positive market outcomes. However, when the market falls, it's often blamed on short sellers, as if selling stocks on anticipation that their price will fall as opposed to buying them in anticipation that their price will rise is somehow immoral. This is bunk. In no other line of commerce are buyers considered morally superior to sellers. Moreover, in the course of our research, when we uncover poor corporate governance and wrongdoing, I believe that we have a moral imperative to act. If we are correct, and only if we are correct, do we make money for our investors. Well, set in 1936, a film, The Sting, with Paul Newman and Robert Redford, has two professional grifters attempting to con mob boss Doyle Lonergan out of his ill-gotten fortune. Newman, on my left, poses as a Chicago bookie who cheats at cards in order to provoke Lonergan into seeking revenge. When Redford is asked the secret of his success at cards, he replies, he cheats. I'm afraid to say this is also true of many companies on the stock market. Often in the course of our research, we have come across companies who seem too good to be true. Companies on the stock market raise money from the public and therefore subject themselves to the rigor of public analysis. This can be positive or negative. Most actors, however, management, banks, investors, are incentivized only for higher share prices and therefore become cheerleaders only interested in positive and uncritical narratives. Actors who are incentivized to think critically are necessary for an efficient market that such a debate exists. Without short sellers, we would be entirely dependent on monolithic financial regulators to expose deceits and wrongdoing. I have to tell you in all candor that their track record in this does not inspire confidence. The moral imperative of the short seller as truth seeker who wins only when they are correct, therefore, is an essential part of a self-regulating stock market, regulating not only corporate governance, but the allocation of capital to good business models. This is highly desirable from a moral and an economic perspective. The father of the American novel, Mark Twain, filed for bankruptcy in 1894, having lost a fortune equivalent to $9 million today from investing in a new invention for newspaper printing, only to see this disrupted soon afterwards by a superior product from a competitor. He was alleged to have lamented from his own personal investing experience that it was easier to fool people than convince them that they had been fooled. Argonaut has had significant success in identifying, through its own research, large-scale multi-billion frauds. Steinhoff, and earlier this year, Wirecard and NMC Healthcare, amongst others. We even wrote about these in advance, yet we were met by criticism from the fan bases of these companies that we were simply talking our own book. And we were bearish because we were short, rather than we were short because we were bearish. We couldn't help these investors. But it is certainly true that without short sellers, these crimes may never have come to light and these multi-billion frauds would still have been perpetuated. Without shorts, we would have a more dishonest stock market. This would lead to capital being allocated to crime rather than good businesses, and that would ultimately negatively impact economic growth. The creator of Sherlock Holmes, Arthur Conan Doyle, once observed that healthy skepticism is the basis of all accurate observation. And that is true in analysing companies on the stock market as in investigating crime, in particular whether a company is run in the interest of all of its shareholders or just the ones controlling the company. We have found that good corporate governance is incredibly important in a sustainable price success. Insiders often cheat other shareholders for opacity and failure to disclose conflicts of interest or related third-party transactions. Unlike many in our industry, we have been prepared to speak publicly about poor corporate governance. Other forms of ethical investing, whilst very popular nowadays, are often subjective in what they define as desirable behavior from company management, and their success is often ill-defined and ill-measured. Our success in highlighting poor corporate governance is defined through the share price performance of our short book. P.T. Barnum, the 19th century showman, was alleged to have boasted, "There's a sucker born every minute and one to take him." And he should have known, given his fame for promoting hoaxes or humbugs, such as the Fiji mermaid or Tom Thumb. Bad corporate behavior and egregious claims to future success often gets overlooked in growth industries with powerful narratives. The more powerful the narrative, the more scope there is for bad behavior. In the desperation of government to find a solution to COVID recently, we've witnessed a number of companies with zero credibility claim to have a promising vaccine candidate, which has pumped up their shares, allowing the same management team to exit their stake and cash in their options, a classic pump and dump tactic. Yet strangely, some people think this is moral behavior from those company management and immoral for us to short the shares of these companies. The exaggeration of expectations is a deceit, though not necessarily illegal, and it forms a key discipline in our identification of short candidates. Frank Borman is a retired astronaut, best remembered as commander of Apollo 8, the first mission to fly around the moon. Between 1975 and 1986, he was CEO of Eastern Airlines. Having originally turned the airline around, the airline filed for bankruptcy in 1989 as a consequence of strikes, high debt, high fuel prices, and rampant competition from no-frills airlines. Phlegmatically, Borman commented that capitalism without bankruptcy is like Christianity without hell. Eastern Airlines, like all stock market insolvencies, went bust because it ran out of cash and the market refused to continue to fund a bad business model which could never sell a product for a profit. It did not go bust because it attracted short sellers. Bad businesses like Eastern Air, particularly with lots of leverage, attracts short sellers because they destroy equity value. Instead of capital committing to continue to fund Eastern Air, a black hole, it looked for better businesses with better prospects. This is not immoral. Without this, we would not have economic growth or economic progress. In the sting, the good guys, Redford and Newman, would con mob boss Doyle Lonergan out of $500,000 for a fake bet on a sure thing horse race winner, Lucky Dan, then faked their own deaths in order to flee the scene. Justice was done. The film would go on to win 7 Oscars, including Best Picture. That is what success looked like for them. For us, success is double-digit annualized returns which come at different times to the stock market and most other funds. Given that beta can be bought cheaply through passive products, we believe that the future of active management is in fact more alpha, not beta. In fact, double alpha. This is what makes the fund a valuable diversifier. We cannot do this without the ability to short, and without shorts, the stock market would be more dishonest and economic growth would inevitably suffer. To expose deceits and bad businesses is, we believe, the moral imperative of the short seller. Thank you.